Good evening, everyone, and welcome to this extremely exciting session on thematic investing, which we at Ethical Advisors are extremely delighted to bring for you in collaboration with Smallcase. As you know, investing is an art, and most of us are looking to make money over extended periods of time and create wealth. Equities are the main source of wealth creation, which fall in the growth category, which all of us know. Some of us do struggle, however, and are often confused between what is the right stock, what is the right sector, and invariably, what is the right time. These are the conundrums minutes from my side, and then open the floor for intelligent Q&A from the audience. Thematic investing, as we all know, is a process of identifying powerful macro level trends. Once these trends are identified, they have to be converted into investable ideas. And once a basket of ideas is identified, we then have to narrow down and create a portfolio of companies and sectors which benefit from those identified trends. Many a times I get asked the question, so is thematic investing similar to trading? And no, the answer is no. When you look at what defines thematic investing and what differentiates it from trading, is that trading involves betting against time based on certain momentum indicators. It is, by its very definition, short-term in nature. It involves trading in stocks with a definite time, frame in mind. Could be a day, could be a week, could be a month. Thematic investing is one step above that. As we mentioned, it means creating a portfolio of stocks, but at the same time using nimble approach for medium to long-term gains. So trading and thematic investing to that extent are two different strategies. The thematic investing strategy portfolio which is created, as I said, is nimble and dynamic. When you create a basket of stocks, it is very likely that some of your bets may not play through or may play through with a slightly longer time frame than you had envisaged. And that's when course correction is needed. In thematic investing, we do take course correction, as you know. So to conclude, you have the traditional buy and hold, where long-term investors just identify stocks they like and hold it for lengthy periods of time, for extended, sometimes for decades. Trading is short-term, so thematic investing fits somewhere in between. There is also a very interesting question, again, as we all get mired with various terminologies. What is thematic and what is sectoral? Very simple. In sectoral, we are restricted. In thematic, sky is the limit. In sectoral, we are restricted by a single sector, maybe financials, maybe industrials, maybe pharma, maybe IT companies. A portfolio manager or an advisor who is creating a sectoral portfolio will thus go deep dive into that sector. He will go across market caps, he will go across functionalities, but his main theme should be restricted only to that sector. For example, I cannot put an HDFC bank in a pharma portfolio. I mean, as simple as that. It's very elementary. And hence, it does limit the scope of stock selection. It also means that you are taking a very concentrated sector risk. You are betting on that sector. And again, my age-old mantra is that there is nothing right, there's nothing wrong in investing. But you must be aware of the risk that you are taking when you're entering a stock or a sector or a theme. So clearly, sectoral portfolios concentrate risk. If anything goes wrong in that sector, then you are exposed to a higher beta. You are also exposed to a higher risk. On the flip side, it allows the fund manager or the advisor to go deep down the sector. So, for example, if you have a sectoral basket on autos, you can have a very varied selection of direct and indirect beneficiaries of the sector. You don't have to stick to the OEM makers. You can have anybody linked to that sector who's benefiting from the growth of that sector, including auto ancillaries, including rubber chemicals, including tire manufacturers, and so on and so forth. So you can actually go several levels deep and play that sector. So in short, sectoral investing is high risk but high return. On the other hand, thematic investing is exactly opposite that. There are lots of sectors. So the thematic portfolio is sector agnostic. It is what people like in cherry picking. They like to cherry pick stocks. They like to diversify. They like to make the portfolio vibrant and versatile. And clearly that is some of the best practices that global investors, including Charlie Munger, Warren Buffett, and the who's and who, even the Indian doyens, Mr. Damani, Mr. Junjunwala, the great Samir Arora. I mean, all of these, if you have been following them, this is what they profess. So thematic investing thus is more vibrant, diversified, creates a well-balanced risk-adjusted portfolio, and does not restrict you to any sector. In short, it's moderate risk-adjusted return that you're looking at. Remember, friends, whenever we are looking at making money, you have to control your greed and fear. I think thematic investing does just that. So moving on to trying to understand what is a theme. A theme could be something which can be played or which have played out with certain time frames in mind. So let's say, for example, in the past, we've had the rising middle class theme. When Indian per capita GDP started growing fast and started going towards a level where it crossed global thresholds, we had past experiences of some of the economies which had crossed those thresholds. So as India was approaching that, and as the penetration was rising, and as the middle class was emerging, which it still is, I'm not saying it's over, but that's one theme. Currently, defense is a theme, with the cross-border tensions rising, the geopolitics playing out in a bit of a volatile fashion. Defense is the theme. Housing and infrastructure could be a theme. Rising rural incomes we've discussed. Agri production has been good. Monsoons have been favorable for 3 consecutive years. So rising rural income could have been a theme. Again, if you note all these themes that we have noted, themes come and themes go. Themes never die. Themes may lose relevance, but they will always come back. It is, and hence thematic investing also means you have to keep a very close watch on what can occur and what cannot occur going forward. So what are the other relevant themes? I mean, the simple question is, fine, we know what's happened in the past, but what are the themes that today we should use to create a portfolio or to asset allocate from our funds? Clearly, we at Ethical Advisors believe that there are several themes which will pan out. We've just listed 5 of them here on the screen. First and foremost, and it is very, again, elementary to us, the demand rebound or demand recovery theme post-pandemic. That is something which one has to be extremely clued on. Good times and bad times are never here to stay forever. That is the basis of our conviction. That is the basis of us creating this theme. Whatever stocks and whatever sectors have been beaten down because of the global pandemic fears and the economic slowdown are the ones which will see the maximum recovery if you have a 1.5 to 2 years view. And that's our first theme. Exactly contra to that, on the rightmost corner, we have listed the resilience theme. Now, resilience theme was a hit, especially in the first 2 months post-pandemic, when we as a global investing community, or I would say we as humanity, had no idea where the world was headed. Was the pandemic going to create huge mortality? Was it going to annihilate the world? Everybody was scratching their heads. It is at that time that we identified stocks which had resilience, which means they fell less compared to the market falls in a particular time frame. Moving on to the next one on the right hand side, healthcare. Healthcare, cleanliness, good practices, Swachh Bharat, all these things have suddenly sprung up in everybody's minds thanks to the pandemic. Things which we took for granted, things which we did not appreciate, including the pharmaceutical sector, the healthcare sector, their importance in our lives suddenly came right to the fore. You can play that as a healthcare theme. Going forward and looking at what the world is headed towards and what the world has been witnessing from the top-down global political scenario, 2000 to 2015 was the era where globalization was the mainstay. Cross-border exchange of ideas, goods, and services was the order of the hour. In short, production and services found their market where economically they needed the most and where the demand was the highest at the right price. Having said that, in the last 3 to 4 years, we have been witnessing a lot of protectionism. We have been privy to a lot of countries raising sanctions against large suppliers of commodities. For whatever reason, there have also been chatters of Indian IT. Of course, these are political noises that Indian IT is taking jobs in the US. Whatever it may be, right or wrong, protectionism has slowly crept in and is actually threatening to dislodge the globalization theme, which was panning out so well. Now, friends, the jury is still not out on this. It is a kind of a bull and bear battle, which we see in the markets every day. But import substitution has definitely gained a lot of significance from the rhetoric which has started by the US, and each and every country is now trying to maximize its gains, its products, its Atmanirbharta. So friends, these are the few themes that have panned out and some of the few themes that we think will play out. We will just quickly spend a minute on each of these themes that we've discussed. So as I said, resilience being the buzzword was created at a time when the markets were weak. The VIX globally had risen to an unbearable level. At the same time, it was rather foolish on anybody with an equity asset allocation to sell down his entire portfolio and move into debt. Even if the short term was weak, I don't think any investor would do that. A trader might. So we definitely had created this theme to move into stocks which fell lesser than the market so that your equity exposure was intact. At the same time, you were sitting in safe, cash rich and stocks, particularly in the FMCG or the pharma sectors, which were the mainstay at that time. We've discussed the demand recovery, so I will not waste time on this. We've already discussed that. Just some examples could be global airlines, travel and tourism companies, restaurants, hotels, leisure-oriented businesses like theme parks, maybe even auto and finance can fit in here, because those are larger market cap in India at least compared to global airlines, etc. Healthcare, again, it's not just the Dr. Reddy's and Ciplas of the world. I'm sure there will be enough innovation happening in the healthcare space, specifically on the immunity side, on the therapeutic side, and also on the e-commerce side of healthcare. Pandemic has taught us one thing, that the life which we were used to, the products and services which we were used to, and the delivery mechanisms which we were used to pre-pandemic are definitely undergoing a tectonic change. I mean, I could also quote education, but unfortunately, there are not many listed education companies today. Maybe if we do this webinar after 2 years, we'll have a basket of stocks. But again, as in the case of education, a lot of things have moved online. And hence, in healthcare, besides the traditional pharmaceutical companies, you could also have distribution chains as they exist in the US. You could also have global R&D kind of companies, and so on and so forth. Just highlighting the healthcare theme is not restricted to only pharma exporters. Of course, you'll also have hospitals, etc., diagnostic centers, and whatnot. Through the thick and thin, businesses which are relevant in our lives always remain present. The cash flows are extremely robust. Some of these companies we see and touch and feel their products in our day-to-day lives. Our lives would not be the same without them. These are the evergreen businesses. These are businesses which in every market, in every economy, there are those choice 20, 30, 40 companies out of the thousands which are listed, which have sustainable business models, impeccable track record of management, and those who are shareholder friendly. These are the companies which are a buy on dip, on every dip. These are the kind of evergreen portfolios. So if somebody wants to minimize his risk and yet play the equity market, and he doesn't want to get too involved with volatility, these are the themes which can ideally play out. We spoke about import substitution and Atmanirbharta. While it can be a dampener to global trade, but when it comes to your own country, when it comes to your own portfolio, you can use these themes. Interestingly, in India, this theme is something which we are also pretty excited about, because we feel that it's not just the import substitution of the day-to-day items, but India is also embarking on its own on Atmanirbharta or self-reliance. India spends billions of dollars on defense. India spends billions of dollars in imports, in importing crude oil. So when you are moving towards energy efficiency, when we are moving towards compulsory localization of defense, I think that's a big theme which will play out. This can be played through the private and public sector. So again, watch out for some of the themes on the import substitution, which many creators, including us, will come out with in the future. So friends, just quickly wrapping up and addressing a very important question that we face from our clients. We do financial planning top down for our clients. And there's always this question when people cross compare products and people try to evaluate the utility of one against the other. In the past, it was equities versus ULIPs. Today, it is small case versus mutual funds. Just stepping back, if you guys are aware, the largest penetration is of Indian savings is in real estate and gold for Indian retail. After that comes deposits with public sector banks and government schemes. And after that, thanks to aggressive marketing, it is actually the mutual funds. Mutual funds have come a long way. It's been almost 25 to 30 years since private sector and public sector have come up with a variety of products. And some of you may be aware that when mutual funds came in, were new, they were not at all trusted because people didn't understand them. But then the rest is history. I think at Ethical Advisors, we feel small cases is exactly at that threshold. It is at that threshold where, as a product, it doesn't have to be pitted against anything in particular. It has a very relevant positioning right next to the deposits, right next to the mutual funds, right next to the ULIPs. But just for the sake of comparing, what are the advantages it brings to the table to be added as a diversification to the various products is something which we need to understand. So small cases are different from mutual funds because they offer a very concentrated and a very intelligent way of playing equity. Mutual funds typically are benchmarked, whereas small case platform is not. So mutual funds managers have to follow or have to benchmark themselves to the relevant indices that they are benchmarked to. So if a fund is a large cap fund and if it's benchmarked to the Nifty, he has to own those 15 Nifty stocks. He cannot not own those stocks. That is the kind of a constraint they work under. All they can do is they can be underweight or overweight those stocks. It, to a certain extent, does restrict creativity when creating baskets. So small case definitely provides a lot more diversification. It also compels the advisor or the fund manager to really put his mind and cherry pick stocks on a forced basis. This is more like a forced selection of why a stock should be in there, not because it is there part of the index. So that is a very big difference, and it can make a huge difference to your portfolio returns. These are also, like mutual funds, They're also managed by SEBI licensed portfolio managers, advisors, and analysts. So you are perfectly safe when somebody is recommending a small case to you. It is somebody who is a professional, just like a doctor. He knows what he's saying. He knows what he has created. Small cases also have a lot of technology advantage in that they are very transparent, they are customizable, and definitely they are most cost efficient. In fact, I think small case is a big disruptor, and I love disruptors because that only adds to the efficiency and advantage to the consumer. So, in short, small case can sit right next to a mutual fund, and investors can benefit from it. So, friends, moving on to ethical advisors and and our collaboration with Small Case, we have created baskets. We have kept our portfolio values as low as possible. In fact, we cater to a cross section of investors. Our mantra is to be the micro SIM card of the small case space. As you know, micro SIM cards in India are a well-known fact, and Indian telecom rates are the lowest in the world. So we are following that practice. We feel that just like the Udan scheme, which the government of India had launched with the mantra that every Indian can fly, our mantra is every Indian can buy equity. He doesn't have to have lakhs and crores of rupees to invest in stocks or to invest in basket of stocks. We have a very deep discounted and a very affordable micro SIM card kind of a price at just 250 rupees per month. And of course, you can it is further discounted if you go for the longer plans. And we ultimately we would definitely conclude that as we are standing at a multi-decadal opportunity in the Indian equity markets, as you probably are all aware, being intelligent investors yourselves, that over the next decade, globally, top down, it is going to be US, China, and India, which are going to be the global growth engines of global economics and global demand. And as a proud Indian, I can say that I'm happy to be part of that through our portfolio positioning and advising our clients likewise, so that we as Indians should take full advantage of our own growth story. We should make our own budgets Atmanirbhar. We should make our own family growth portfolio trajectory very strong. We should have a risk adjusted allocation to equity and small case via any advisor or even ethical advisors on the small case platform is the right way to go for it. We have our website at the bottom. Feel free to visit ethicaladvisors.smallcase.com. You will get further details of our portfolios besides what we have just discussed. I will just skim through some of the offerings. First is the metals pack, where you subscribe for a minimum investment of just 18,500. That's our high beta bet for high risk lovers. Is definitely high risk, high return, but we are extremely confident that this is the theme which is a double leverage on global recovery post pandemic. So people with a high risk appetite should definitely have some of these metal stocks and the metal pays here. The resilient pack, minimum investment just less than 50,000. We have the dependables, where minimum investment is about 1,15,000 or so. And our all-time favorite, this is just 7,000 rupees, 7,000 odd, which is pocket money investing. This is something which even a college student, if he wants, he can actually start saving from day one, as his father or his parents give him pocket money. So friends, this is what all our offerings are. This is a short overview on what our thoughts on the thematic investing is. And we would love to interact with you guys on any questions that you may have. We really thank and we are indebted to Small Case and its promoters for giving us this opportunity and coming in front of such an educated and an enlightened audience as you guys. Okay, friends, I think we've got a few questions rolling, so we will start with those. First question is from Devang. Is ESG also part of thematic investing? Yes, absolutely. ESG has been probably one of the oldest themes. And I have, in my experience, just to share with the viewers, I used to be in global investment banking with leading global firms, and I have spent almost 25 years with them. ESG, as far as I know, started in the developed world almost 20 years ago, and is definitely part of thematic investing. Yes, absolutely. Prashant, the question is the steel sector good? Uh, Look, we, when we say metals, we would rather actually go ahead and invest beyond steel. Uh, Again, when you say steel, you're restricting yourself to a particular metal. Metal itself, when you look at metals or autos or financials, you're as it is narrowing down your choices and you're taking a higher bet. But when you say just steel, you're taking a further bet. So what we believe is that when you look at metals, you should look at all sorts of plays, not just the steel sector. Steel also is a beneficiary not only of consumer demand but also of industrial demand. So to answer your question in short, yes, steel sector is good, but at the same time, you would rather play that through a diversified metals basket. Very interesting question from Yogesh. This is something which like I said, any disruptor does create ripples, and so does a disruptor like small case, in my view. Small case, basically, the question is, how does it compare with expense ratios in mutual funds? So, mutual funds obviously have expense ratios with multiple costs embedded in it. It's distribution, it's manufacturing, basically it's what the fund manager charges, it is the regulatory charges. All of that is packed into one. Small case definitely is much more cost effective compared to a mutual fund. Now, again, we are restricting ourselves to equity mutual funds, not debt. So clearly, uh, they are much more cost effective. Uh, the small case profit from me investing to them, I think that's a bit of a question I'm not able to understand. Maybe you want to rephrase that. Uh, Small case, as you know, is a platform which is a subscriber driven model. It it actually brings together ideas creators like us, people who are experienced. It connects us with people who are looking for ideas. So I think it's a platform where subscription fees is the only thing that you pay. You obviously pay your own broker. So if you're with whatever broker, that's the charges you pay. Nothing else besides that. Samir is asking, do you guys also are you consultants for our investments? I'm presuming that you are looking at portfolio management and portfolio advice. So the short answer is yes. If you go on our website, www.ethicaladvisors.in, you will see our entire profile. I will display my card again at the end. We do a whole host of things, yes. Um, it's very, very kind of Dinesh. We'll have coffee, yes. Uh, God willing, once the COVID pandemic issues are over, we should have coffee. It's very kind of you. Um, Sunny, I just ran through the investment packs of at least our platform. It starts from the budget investing, which is called the pocket investing. It is ideally created for low budget. I mean, as low as a youngster or a student. It is extremely cheap on the cost, but you need just 7,200 bucks to buy our baskets. So it is as low as that. And of course, as you all know, for the benefit of the viewers, you can go for monthly or quarterly or 6 monthly packs. You can renew that anytime you want, and we will be with you all through the term that you have chosen. So the minimum investment 7,200 or whatever was there in the students pack, or called the pocket money pack, going all the way to 1,45,000, 1,50,000. And again, guys, think about it. Today, you try and buy one share of MRF, it is 65,000 bucks. Through small case, through our platform at least, you can buy a portfolio if you have only just 7 or 8,000 bucks in your pocket. And these are very, very intelligently created. I can assure you of that. Lalit, you want our credentials? Again, like I mentioned to our viewers, please visit ethicaladvisors.in. My entire professional history is there, and our firm's credentials and our tie-ups on multiple platforms are there. We do a lot more things besides investing. So kindly, I mean, we'll be honored and delighted if you visit our website. Yes, Kamlesh Babu, yes, absolutely. If you go to ethicaladvisors.smallcase.com, we have already showcased our performances of each hour. We have about seven. We have three more in the pipeline. I can bet you those three are going to beat this seven hollow, because there is going to be so much ingenuity out there. There's going to be so much differentiation out there. It's not funny. And that's why it's taking a little time. But yes, you can see those, the back testing has been done. You can see it there. Do they come as an offering on Zerodha? Yes, Vaibhav, they do. Please go to ethicaladvisors.smallcase.com. We have listed a whole host of approved brokers, and if your broking account is with them, yes, by all means you can trade through Zerodha. Absolutely. Pratik, what is the scope of ESG funds? ESG funds. I think every sector or every theme, sorry, has its relevance. As you know, ESG, in ESG, E stands for ethical standards, etc. Uh, and the scope for this is unlimited. ESG funds are available in different packages. ESG funds also, as I've been saying, these are the first funds or the first set of funds that globally conscious investors, especially large multi-billion dollar pension funds, whom we used to advise in my previous role with my employers, or the large endowment funds, etc. Or, for example, the funds in the US, which I used to service, particularly on the retirement and pension funds. I will not take names, but you know the large names. These are pools of money which are collected specifically to invest globally. So US is the largest market in the world, is the largest source of capital. And those funds will definitely, as I remember, as an investment banker, we had done the IPO of one of the large public sector oil companies. And unfortunately, they were operating in Sudan. And, and some of the valuation parameters and the company's fundamentals were extremely strong. However, the ESG bent of funds, or those funds were ESG type, they refused to, they were constrained. Much as they liked the story, they could not invest on those stocks. So I think ESG can be a really, it is there to stay, and it can be a very, very long-term theme which can play out. Um, Sorry. Rebalancing, yes, very interesting question. Rebalancing is done very well. Any small case publisher, when he has recommended to his advisor through his advisory network a basket of stocks, let me be very frank. He's watching those stocks very regularly. It is okay to say buy and hold and buy and forget, but just like I will give the example of, let's say, a person, one of our soldiers, or let's say Siachen glacier, then or the border, as the soldiers are protecting our borders and they are watching over the enemy lines in Siachen or Kashmir or wherever they may be, or in the deep sea or in the air. An advisor or a portfolio publisher is exactly like that. He is watching the portfolio and the market literally every day. He may not balance or rebalance, or he may not be trading. But sometimes, so if your publisher has not sent you any rebalance for, let's say, 2 or 3 months, it is human of us to think, "ये कर क्या रहा है? What is he doing? I mean, is he even there?" But trust me, a professional knows what he's doing. You will not hear of a skirmish on the border every day, but he's there watching for you, and hence you are sleeping well. So somebody is definitely watching. Rebalances are done, at least by us, only if our stocks have met the target prices that we have identified, or in case something is not panning out the way we had earlier anticipated. It is likely that out of the 15-20 stocks that we have, some of the stocks may not be performing not from a price perspective only, but from the fundamentals as well. So their course correction, as I mentioned in my previous slide, in that case, definitely we will require. Of course, most of the times we are happy rebalancing when we are churning the portfolio and getting booking profits and making it grow, and then we're moving into other opportunities. So I hope that answers the rebalance question. And it is imperative for anybody who is buying a small case or anybody who's investing a small case, irrespective of the amount he is investing, that he doesn't take a short-term view. And again, I take the viewers back to the slide where we are distinguishing it against trading. Trading is something, an independent activity. Please don't try to do it through small case. You do it separately. Small case, you should have a medium term approach and let the small case provider do the churn for you as and when required. Many a times, clients ask us, "Oh, this thing is just I bought it and it's down like 5%. So should we just get out of this and get into something else?" Uh, I think that is not doing justice to your portfolio, to be honest. We had a if you guys obviously are tracking the market as avidly as we are, you would have realized that 3 weeks ago on a Monday morning the market just tanked. Everything looked gloomy. uh, on those days, I think it's better to just first understand why the market is tanked. And if it is a short-term aberration led by just financial stocks getting hammered, I mean, you guys will realize that the current volatility is being played through the bank nifty. That is pretty evident. And just because of some random news on the Chinese border or something, you just do nothing. So my point is, rebalances will be done with a mature approach, with a fundamental view, and with a very very solid reason to rebalance. You should go with that. Avoid jumping from one basket to the other. Give your small case at least 3 to 6 months, at least a year, and I'm sure if it is well created, they will perform and they will be worth its salt. Hemant, if you need to, it's a good question. Resilience team, which of these stocks are incorporated? My friend, you will have to subscribe to our pack to know that. So even if it's for a month, you can do that and you will know what all the stocks. It will open up the entire Pandora's box. Arpan asks a very interesting question, friends. He is saying, can you share some details regarding portfolios and how they will take care of capital protection? Uh, Capital protection. Now, if viewers are really keen to know on capital protection, I'm digressing from here, and small case needs to excuse me, but they can just go to our website, ethicaladvisors.in. Uh, Capital protection cannot be done through equity markets. We have other tools through which we advise clients to do it. These are documented on our YouTube video series. So kindly, if you don't mind, go to our main website, ethicaladvisors.in. And there you will find a whole host of capital protection products and capital protection solutions. If you're looking at pure equity platforms like small case or mutual funds or pure equity, unfortunately, you will not get those. Pushparaj, no, it is not an ETF. If I were to come on and share my thoughts with you as a 30-year-old veteran in stock markets and then give you a small ETF disguised as a pocket money investing, I should not be on this podium, and it would definitely not be ethical. Uh, to just share some thoughts, and you're welcome to subscribe to ethicaladvisors.smallcase.com and maybe take a 6-month pack or something. But when you look at the contents of that uh, uh, portfolio of the pocket money, uh, you will be amazed at the stocks we have put in there and how affordable we have made it for. Again, I repeat, like in Udan, where the government of the Ministry of Civil Aviation, Government of India, their mantra was every Indian can fly. Our pocket money portfolio has that mantra that every Indian can buy a risk-adjusted growth portfolio for himself. So you will be amazed at the vibrance and at the stock selection which has gone into that portfolio. And yet it is just an affordable 7,200 as we speak. One word of caution, that portfolio when we started 2 months ago was around 5,500. So you will realize that it has only grown in just 2 months. So I mean, it has done fairly well. So if you want, seriously, if you're looking at investing, please subscribe to it and you will see the benefits. how do we go from idea to stock selection for the healthcare theme? What are the steps that need to be taken? Kumar, healthcare, I can give, I mean, to create a portfolio out of a theme is an art. It is something which can come with experience. And if viewers are viewing me, you can see a lot of gray hair. So that's all experience all around me. Uh, Having said that, experience is also something which can come through somebody who has been in the market for, let's say, a couple of years and has got a touch and feel of trading. I think when you combine these two, you get a fantastic product like small case platform or small case ideas. So just to answer your question in brief, to just give you some starting points, and my friend, you'll have to do the hard work going forward. Uh, when you're looking at healthcare theme, look at 4 or 5 baskets. One set of stocks are the traditional pharmaceutical branded players. You have all the names, as you know, out of there. You also have a huge export story of pharmaceutical exports. Unfortunately, it got suppressed when the new Trump administration started putting curbs and started the US FDA started really going after Indian companies. That took a bit of a knock. But my feel is that the kind of value that we supply as Indian pharma to the US and at the cost at which we supply, nobody in the world can do it. I'm sure there are Israeli companies. I'm sure there are other European companies for technologically superior products. But those products which go out of patent, I can tell you the top 4 Indian companies are right up there globally. So you had the IT theme, you had the pharma theme in the last 20 years. That will continue. But you have to look beyond that. You have to look at companies which are very strong API manufacturers, bulk drug manufacturers and exporters. Without that, the formulation won't be made. You also have to look at healthcare in India. Now, again, digressing from here, I'm putting on my hat as a one-stop shop services provider, where we also provide solutions for mediclaims, etc., to our clients. And I can assure you that there is severe underpenetration and lack of understanding of the simple product called health insurance, also life insurance. These are the 2 most underpenetrated products. Any slide that you see globally, India is even below Vietnam and Thailand in penetration. When you look at just that at the back of your head, it is a no-brainer that diagnostic centers, hospitals, certain e-pharma chains, if they come in the future, all these things will get added to healthcare. So without wasting too much time, I'm just leaving you with a few thoughts. You can do some work on that. And I'm happy to exchange notes on WhatsApp if you make progress or if you need any further guidance. Um, do we use algorithms for our research? No, we don't. We feel that, there's nothing to say that algorithms are good or bad. We believe that going bottom down to the company level, to the management level, and identifying themes and trends. This is the simple, steady, age-old, boring Warren Buffett style, or you have anybody with a long-term investing background, Sir John Templeton or Franklin Templeton. So these are the styles which we tend to stick to when we create our small case portfolios. We go right down to the company level, because when we create a small case, friends, remember, it's not just you're buying stocks for that to go up and make money and get out. This is not trading. When we are buying stocks and recommending to you in a basket form, we are making you shareholders, part owners of those companies. Let's say, for example, Maruti is in our auto basket, and we have put, let's say, 50 shares in there or whatever. You are an owner of Maruti. You need to make money from Maruti's operations. And will you make money because of their earnings growth? That's the approach we use. We don't use, unfortunately, algorithms for our research. It's boring, plain vanilla research. So just again to share background and to maybe blow our trumpet a bit. In the lockdown period, we've analyzed close to 500 companies, including their balance sheets, their annual reports, their management commentary, the industries they operate in. We narrowed down 150 of those stocks, and from that we have created the baskets. We continue to do that. That basket is ever changing. The 500 is never constant, and our endeavor is to force select those 20, 25 stocks which can make a difference. Hopefully be wrong in 5 only, and maybe the 15 or 20 which we've got takes it to the next level. 5 mistakes we can, so that's our approach. We are very, very conscious. Since we talk of algorithms, it's also worth discussing what we are completely crazy about. We look at management caliber, we look at the business first of all, whether this business is worth owning at all. So I'll be very honest, personally I don't like telecom. Telecom is a very capital intensive business. I don't like hotels unless there is deep value, deep replacement value. So there are certain parameters, there are certain premises which we work on, and every advisor, every professional will have his own approach. Just like any doctor, every doctor will have his own set of professional benchmarks or guiding posts. We use those, not algorithms. Sushant says India has always been dependent on imports in a big manner. How do you feel India is placed to handle import substitution? I frankly believe that India is continuously going to lead. The GDP growth will be led by services. Next will be agri, and then will be manufacturing. So I'll be perfectly honest. I don't see Indian manufacturing, irrespective of what noise we make of being the next big global supplier compared to China, dislodging them. I have heard this for the last 30 years, and all through my investment banking career, I have heard this multiple times. And I'll be really pained to share that for some strange reason, we as a collective bureaucracy, politicians, industrialists, all of us put together, somehow, somewhere we have missed this opportunity several times. Having said that, having missed it several times is making our resolve even more stronger. But will we go there in the next 3 to 5 years? I think it's going to be extremely difficult. There will be spots of opportunity. There will be definitely things which are, I would say, low-hanging fruits, which we can easily pluck out. But so to say that tomorrow we'll dislodge China and China will, I think that's just too much of, either it is rhetoric, it is very good intentions politically, I fully support that. But practically speaking on the ground, as I speak to our clients who are in business, India still has a long way to go in terms of ease of doing business at the ground level. And that is the only hindrance that we will have to overcome. Once we decide to break that barrier, sky is the limit. It's then that I will say, look, we are the next China and we are going to get the gold medal and China will be the second. But till then, it has to be opportunistic and specific to certain opportunities. Import substitution can also be driven by one's own policies. So, for example, if we raise tariffs like what US did, it suddenly raised tariffs on Chinese products, including Chinese steel. That is one way of doing it. But if you are an economist and if you are an industrialist or if you are a corporate executive and not a politician like in the US, you would laugh at such measures. Imagine by raising tariffs on Chinese imports, what has the administration done? Very simple. You have only raised the cost of goods for your own consumers. Simple. So, I mean, honestly, but these in the short to medium term, these can definitely give a boost to the manufacturers of those products, and it can give some kind of a short-term advantage. I hope I have answered the import substitution part to your satisfaction. Anshu, absolutely right, and absolutely right in terms of what you say. Question, guys, is evergreen businesses, haven't they just stagnated in terms of capital appreciation of its stocks? And shouldn't we be investing in growth companies? Absolutely, I agree. But remember, let's just go back to the point I made. Investing is an art. Investing is about risk management. And investing is also about each person's choice that he wants to make. So there are different risk parameters that each individual decides for himself. And hence, again, to make it very simple, investing is like a big buffet. It's like a big thali. You may not like a shrikhand and I may like an apple pie, or somebody may like a tikha achar. So what is right, and there's nothing called right and wrong. An evergreen business, if somebody is willing to buy something today and hold it for the next 10 years and not trade at all, and believe me, there are people who do that, then evergreen businesses is the starting point. And as he appreciates or as he understands the risk better, as he earns more money and he's comfortable with his base portfolio performing steadily, he will then add on risk to maybe a resilience or maybe something else, or maybe, and eventually, of course, he will hope that he'll ends up in the metal space. So it is a process. And in terms of uh, the ever interesting question that you posed, that have they stagnated? An evergreen business cannot stagnate for long times, because what happens is that stock markets typically are like waves. There are good times and bad times. It is in bad times that people will always flock to those evergreens. So these evergreens are like your salad in your portfolio. You have to have them in some shape or form. Evergreen businesses also will sound boring when the market is in a tearing up move. But these are the same stocks which will hold you well in terms of bad times. And friends, if you're looking at 3, 5, 10, 20, 30 years, again, trust me, I have seen three big bear markets, global calamities. I have seen maybe four or five of those, not three. What we have seen in 2020 is something we had never seen. So every next calamity has been a learning for me. And hence, whatever we've said today or whatever portfolio construct we've done on our small case platform reflects all of it. It reflects my greed with the metal space. It reflects my fear in case of a contagion. It reflects, I mean, obviously, we're not looking at the, kind of a apocalypse scenario, because in that case, all of us are dead anyway. So we should not price that in. But you have to balance all those emotions and pack it into your base scenario. Kumar is saying, what is the maximum drawdown in your small case list that you manage? Friends, Kumar, we've just onboarded small. While I've been doing, I have been in the financial markets for more than 30 years, and my own firm, Ethical Advisors, which is a one-stop shop, has just completed its 4 years. Small case is our latest addition to our portfolio. We got active with them just 3 months ago, and we are happy to say there have been no drawdowns. We are open to any further questions. If you want to earn more money than a fixed deposit, where should I invest in a risk? Ninad, go for the pocket money pack that we've created. That's your best bet. We also have dependables. That's a very, very good, solid, long-term portfolio. You can take that. I would definitely recommend that. Okay. The next question is, Naveen, how safe is it for freshers? Can a fresher invest? Yes, absolutely. I'm very proud to say that my son is 22 and I have encouraged him to invest in equities on his own. He has a bit of capital, and a good starting point is the pocket money package that we have. I would also look at the dependables portfolio. Friends, remember, whatever our, so each, like I said, each portfolio manager and each advisor will have his kind of a theory or a philosophy. Again, just to repeat, for the sake of boring the audience, we believe that whatever, even if it's a risky portfolio, the companies and the managements and the choice of stocks that we've done, we have filtered it through several filters. And you do carry the equity market risk. Of course, we are at 40,000. Guys, if you realize we are just 3% short of an all-time high. So we are clearly just on the cusp of breaking out on the upward momentum. By the way, US markets have already done that a month ago. So we are following that, and that's been our consistent view as well. So I think this year is the year in which you consider putting your money to work. We are always of the view that if you have 100 rupees, you should stagger it in 3 or 4 different installments. Uh, Not necessarily a monthly SIP. You can do a monthly SIP also in any of our packs, by the way. Um, so if somebody wants to put, let's say, 8,000 bucks a month, he can take the pocket money pack and do it. Or if you want to put a lakh a month, there are several choices. For that apart, if somebody wants to say he has selected out of our 7 packs, no, I want to put money in Resilient is a very, very vibrant and dynamic pack, which is probably our most, I would say this is our kind of a flagship product where we are a bit on the momentum side. So this is good for some amount of capital for a bit of these are momentum breakout plays which we have identified among the good companies. So that is a good bet to put. If you have, let's say, 5 lakh rupees, split it into 2 or 3 or 4 installments and slowly deploy it across strategies or in the same strategy. That's how you can manage risk. You cannot be out of the water and say there are no swimming. You have to dip your toe at some stage, then go up to your knee levels, then come to your waist levels, and then start swimming. It is as simple as that. So, making it sound as simple as that, that's how you would approach investing. Yeah, Kaustubh, reviews about small case. Okay. So the question that Kaustubh Mulle is asking is some of the reviews that he's read about small case is that there is a lot of buying and selling, and that leads to capital gains, and it ultimately makes gains very dismal. I think it's a very interesting question, simply because to answer you, you will pay capital gains tax of 15% on a short-term gain. So let's say you've bought a small case and you have made you made 100 rupees. Yes, you will pay 15, but it also means that you're taking 85 rupees home. Correct? So I would not agree that your gains are very dismal. You are paying capital gains tax on the gains made. So remember, for every 15 rupees on the short term that you're paying, you are taking 85 home. It's just that you are not taking 100 home. That's it. And if that stock is sold after 1 year, you are actually paying only 10%. So I don't agree that the frequent churn is going to lose you money. It's because it's earned you money, you're paying tax on it to the government. I hope that's clear. Or you can just WhatsApp me separately. Janu Harshvardhan is asking, is your basket only growth stocks or of monopolies or whatever? No. So, like I said, we don't, as when we say every Indian can fly, is what the aviation ministry said. It did not say every Hindu can fly or every Muslim can fly. So, likewise, when we say every Indian can buy, we don't distinguish between growth stocks or monopolies. We have we don't look at companies that way. We won't buy a company just because it's a monopoly, because monopolies are the ones which are at maximum risk. We do like a few duopoly stocks, so I can discuss that separately offline. And that's part of our core portfolio, core family portfolio as well. And we feel they will do very well. But those duopolies have made it because there are certain, I would say, business moats, or there are business constraints why others cannot duplicate those. Just because somebody is a monopoly is not something we get excited about. So, like I said, we have multiple filters, and these are not the filters we use. And of course, we are looking at growth stocks only, largely growth stocks. In fact, most of our baskets are growth oriented. Otherwise, they would not be there. PSUs. Yes, Giribon, we have a PSU basket. Good you asked. And we have, obviously, like I said, we have several themes in the pipeline. But we have a dividend yield play. We have a separate PSU basket. PSUs, as one of my friends, he never invests in PSUs and he's done well so far. His definition of PSUs is pretty sad units. That is what he calls them. I have a very different view. A company, a business, whether run by public sector or private sector, at the end of the day, you have to look at ultimately the return ratios which it generates for you. You should never see the company's name and say, I'm buying Hindustan Lever, and I'm not buying Coal India. You should never do that. You should look at the financials dispassionately. And we have some PSUs mixed into our various portfolios, but we have separately created a PSU basket of those PSUs which are highly profitable, which are highly well managed, which are dominant in their businesses, and which have return ratios. You will be surprised if you analyze some of the PSUs. They have return ratios almost close to Hindustan Lever. Hindustan Lever I consider as an absolute peak in terms of what it generates as shareholder wealth. Nestle is the second one. So they actually sit in between those two. You'll be surprised. So Giri, we don't have any aversion. Like I said, every Indian can fly, so every Indian can buy, and every PSU or any stock that meets our criteria will be in our portfolio. It is also very pertinent to note at this point in time that I'll just share, since we are taking a short break from questions, I'd like to share a few of my thoughts of how to, move forward or how to approach investing. See, small case or equities, single stocks, ULIPs, at the end of the day, they are an asset class. But friends, whether you have 7,000 bucks in your pocket or you have 7,000 crores in your pocket, our mantra at Ethical Advisors is always do a plan, always do an asset allocation. Talk to an advisor if you feel the need. Just like when we need professional advice on the medical side, we do go to our doctors. We are all SEBI registered advisors. The entire small case platform is built of highly intelligent, highly efficient, and highly capable set of advisors, and they know what they are doing. So whether they are equity portfolio constructors, and if they are good in the view, obviously that's why they are there on the platform. But we as a financial planning firm, we take it to another level where we do asset allocation based planning. Make sure that you don't keep all your eggs in one basket. And if you follow these best practices of goal based planning with a very strong product like small case in there, you can never go wrong. uh, you can definitely maximize your wealth potential. Again, one mantra which I've always followed in my professional career is that your wealth is your child. In fact, it is the only child which doesn't need to be 18 years old to work for you. So if you have wealth, and if it is stagnating in a bank account, or if it is stagnating in a 3% deposit or a 5% deposit, I think you are honestly wasting your time, because the inflation itself, at which currently, of course, inflation is low because the whole world is in a reverse gear. But just let's say after 6 months or after a year, when everything is back to normal and the pandemic blues are out and if inflation comes back, seriously, your money will be you're running negative returns. So your wealth will actually degenerate. If you have a crore now and if it's not allocated properly and invested properly, it will actually stagnate. So platforms like small case, mutual funds, any such growth oriented portfolios should be an integral part, but it should be a well planned portion or proportion of your total capital allocation. Like I said, nothing is bad. Even a tax free bond with a regular return is a good investment. So depends on your objectives, depends on your cash flow, depends on your debt profile. There's a lot of art that goes into making a financial plan, and luckily we can claim that we are good at it. So make a plan for yourself. It's not that difficult. You don't need us. We are there for you. But it's very simple. If you use that approach, you will never go wrong. I will just at this point in time, uh, I'm assuming that we've had that the viewers have benefited from our interaction. Uh, I really heartily thank all of you for being on the show, for spending your time with us, for sharing your queries and questions. I learned a lot from you. We learn every day, and we are eager to learn every day. So thank you for your time. Thanks to Small Case for giving us this platform. Uh, our official Twitter handle is @ethicaladv. It's displayed on the screen. My personal Twitter handle is there, and also of our business associate. Our website is listed on the left-hand corner. It's www.ethicaladvisors.in. You can also reach us via WhatsApp or the contact us page there. And our small case association is via our webpage, ethicaladvisors.smallcase.com. Small case as a platform is invaluable. As you know, they have their own Twitter handles, they have their own website, and we are absolutely delighted to be part of their association. And we are honored to be associated with them. We feel small case, like I said, is an integral part of our financial planning now. And we hope that we can make a difference to all our clients and hopefully to some of you who may want to seek our advice on the same. With this, I thank you heartily and I look forward to interacting you on a one-to-one basis if there is any questions that I can answer. Thanks again and have a great evening.